to oversimplify, there's sort of like, three types of investors, I feel like, out in the PE world today. There's like the guy, the dog in the truck with the checkbook who's like, hey, here's the check. I'll see you at the quarterly board meeting. Don't screw it up, right? There's the opposite end of the spectrum where you've got somebody who has got a small army of people that are, represent their value creation team. And the deal closes, you got, 40 people in 3-piece suits and 3-ring binders camped out in your kitchen telling you how to run your business. And then there's like this happy place in between.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Mike Wilkins, and he is a partner at Shamrock Capital. And what's really different about Shamrock is the types of industries and companies that they invest in. They deploy capital into companies in media, entertainment, content, sports, and a bunch of different industries where I would say traditional private equity just doesn't focus as much. And what I really enjoyed about that conversation is that I often feel like PE overlooks a large set of assets or companies simply because that's not in their thesis or that's not how they raise money from LPs. Meanwhile, there are all these quality assets out there that can drive a ton of alpha for their fund, for their investors, but they're kind of handcuffed or they just never went that way. And what's really great about Michael is that he has a ton of industry expertise, and the firm itself has over 40 years of experience in this space that they kind of bring to the table. And they've been part of some major transactions with major companies. And on their content side, they've worked with major artists and different firms as well. So I thought it was a really great conversation. And Michael had a really great perspective on how they drive enterprise value, how they source companies, how they differentiate themselves in the marketplace. And I think as you're listening to it as a PE firm, I think it's a good way to kind of think about how to really specialize and differentiate yourself in a marketplace for more deal flow and to drive more enterprise value for your company. So with that said, I'll leave you to it. Enjoy the episode. All right, Michael, welcome to the show. How's it going?
It's going great, Shiv. Thanks for having me. Appreciate what you do and the content you've put out. It's been fun. Looking at some of the the previous work and seeing a lot of familiar faces and listening to some of those folks share their wisdom. So I really appreciate the opportunity.
Yeah, and we were just talking about how the private equity world is just so small and everybody kind of knows everyone. So why don't we start with your background and Shamrock, and let's take it from there.
Yeah, sure. So I'm a partner over at Shamrock in our within our private equity fund. I also sit on our executive committee. I've been at Shamrock for about 5 years. And prior to Shamrock, I spent 25 years as an investment banker. I started at Goldman Sachs back in the mid-90s and spent kind of the first half of my career in the bulge bracket and then moved to the mid-market. And for almost a decade, I ran the technology, media, and telecom effort in a middle market investment bank called Harris Williams. And then had the good fortune to join my friends and longtime client, Shamrock, like I said, almost 5 years ago, and it's been great. Shamrock, just maybe some background on the firm. It's an interesting kind of backstory. The firm's been around since 1978. We were part of the Disney family office. So we were the private equity arm of a multi-strategy family investment office. And between 1978 and 2011, that was sort of the mandate. In 2011, with Shamrock 3, we bought Disney out of the management company and stood up the firm as a completely standalone entity with our own LP base. So if you fast forward to today, we're about $7 billion of assets under management, and we invest through two strategies. We have our private equity strategy, which is where I sit, and I'll come back to that in a second. And we have our content strategy. The content strategy invests in intellectual property and media rights across film, TV, music, sports, and gaming, and has some really iconic assets, some of which you maybe have read about in the news recently. And on the private equity side, we have two funds. We have our flagship fund, which is about 1.3 billion in size. That's currently our fund six. And then we have our Clover fund, which is a little over $300 million. Both of the funds we're sector focused investors. So both of the funds focus on six sectors: media, entertainment, sports, communications, marketing and advertising, and then education. And the difference between the two funds is really the check size. So our Clover fund, which is our small cap fund, focuses on checks of, call it, 15 up to about 50 million in size. And then our flagship fund focuses on checks between 50 and 250 million. And honestly, Shiv, as long as it's focused within those six sectors, we're sort of indifferent as to whether it's majority, minority, growth, or buyout. It's really, can we leverage our sector expertise, to help drive an outcome and create outsized returns for our investors.
Yeah, and this one thing that has really jumped out in the private equity world over the last few years is, historically PE has been associated with, I'd say, more legacy companies or turnarounds, and then the last decade, really software and technology companies have become a big focus. And the new trend that has been, I'd say, apparent for the last few years and is really expanding is in this world of sports and media and content, because private equity is starting to see these assets as being incredibly valuable. And we've seen that with in terms of big transactions with sales of professional sports teams like the Lakers or the Celtics. But then at the same time, on the content side, it's something that you don't hear about as much, but it's a huge asset class that has recurring revenue, quote unquote, and a ton of enterprise value that's sometimes overlooked by other private equity firms. So why don't you talk about that and how you guys are trying to capitalize on that opportunity?
Yeah, given our heritage, right, that's where we grew up. And so we've always used that as a competitive differentiator. You're talking about close to 50 years of sector experience. I think part of the reason why private equity for a long time, except for a very small group of folks, stayed away was that even though that's a big industry, it's like a small world. It's a small network. And there is real nuance to understanding those business models, what's going to create value. Pattern recognition becomes really important, understanding kind of, the value of assets. You're looking at different metrics than most businesses and most private equity firms are looking at to assess things, everything from valuation to, how to drive a value creation plan, you name it. So there's real nuance that creates that differentiation. Getting back to us, we spent, like I said, almost 50 years in those sectors. And so with that comes this really deep connectivity to the sector. And when I say connectivity, that comes in the form of, network, and that could be, to the studios, that could be to various sports teams and the ecosystem that serves those businesses. It's the CEOs who have grown up there, network executives, consultancies that play in the space, bankers who live there. And so even though I go back to what I said before, even though it's a big industry, it's sort of a small world, being hyper connected in that space has been a differentiator for us. And so that approach has sort of set us up for, a situation where we're seeing a lot more proprietary looks than, just participating in banked processes. And even in those banked processes, that know-how and network allows us to create differentiated angles to say, look, we're going to show up, we're going to be different, we're going to be able to stretch on value maybe in a way, or be able to, endear ourselves to the founders to say, hey, we can help with value creation and drive, growth in a way that maybe somebody who hasn't grown up here can. And so all of that is really important. I think for the broader market, though, people are wading in because they do see the opportunity, and so many of these other subsectors are picked over. But that network and know-how matters.
Yeah, can you walk through that a little bit? Just as an example for the audience, a notable transaction that Shamrock recently did is you sold a bunch of Taylor Swift's previous albums or 6 albums or something like that. So talk about, in situations like that, how do you look at valuation? How do you look at value creation? Which metrics are you looking at? Because we're looking at like a traditional SaaS company, it's straightforward. Like you look at your revenue growth, your EBITDA margins, your rule of 40. There's a bunch of metrics that you kind of can use, your net revenue retention, that kind of tells you, is this a healthy company to kind of acquire? But in these different assets, what are some of those KPIs or ways of measurement that you're looking at to figure out, is this the type of thing that we want to deploy capital into? And then how do you also forecast out the exit plan, or how are you going to actually get liquidity on that investment over time?
Yeah, I mean, the transaction that you referenced was done out of our content fund, which, I'm as part of the firm, but, it wasn't a transaction that I was personally involved in, but I can, share some color on, in situations like that, our content fund has proprietary data feeds, which help look at the streaming volume of various artists. And so to your point about looking at different metrics, very different metrics, right? And, without having that deep connectivity into, some of these data sources that can help provide an understanding of, what is the market saying about, the long-term potential of a particular asset. And in this case, music streaming, it's pretty hard to come up with sort of a predictable, underwrite. But because of that, sector knowledge and know-how, because of those proprietary data feeds, you can create more of what for us would be a more traditional approach to valuation and thinking about, the ultimate exit. If I think about how we do that on the private equity side, across those sectors, again, it comes back to having that proprietary network, and in some cases data, and in other cases just connectivity to executives who have grown up in that space that can help you see around corners. And so we're trying to take a more holistic approach than just saying, hey, I received some data from the company that is selling. I've gone through the typical paces of process specific to analyzing that data from like a traditional PE model, and that suggests that the underwrite should be X. We're trying to say, what is previous experience in the space dictate in terms of where we should go spend our time, either engaging with other firms that have played there or with executives that grew up with there, that can provide insights to saying, are those assumptions that we're applying to, whatever data we're getting from the selling company, how realistic are they? How strongly do we feel about that? Could we see it from a different angle that maybe somebody else didn't? And then overlay our value creation plans to then drive outsized growth above what, somebody who maybe didn't grow up in a particular sector has.
Yeah, and on the PE side, like some of the other types of companies that you're working on or have invested in also have a similar challenge, right? Because it's not built the same way that a more traditional technology business would be. So talk about that, the value creation piece there. Like, how are you diving deeper into those companies and figuring out where those levers are, and how you kind of are going to grow it to the next level before you have to potentially exit those companies?
Yeah, I mean, I think one of the biggest differentiators is getting our value creation team involved early. And as an investor, there's only so much, I can look at the business, and I've grown up in particular sectors, and I can say, like, I think this is high value add, but how do we set ourselves up early for the exit? And do we think that this is a particular asset that we can drive an outsized outcome? A lot of that has to do with that partnership with the value creation plan, saying, if we dig under the hood here, if this aligns with one of our theses, right? If we dig under the hood, are there things that we can do to help amplify either the growth, profitability, or market status of a particular business? One of the first deals that I did when I came over to Shamrock was a virtual lab and assessment software business called Scalable. And Scalable was basically a category creator in a world where there's a lot of companies out there that are providing a certificate that said that, hey, I have a certain set of skills in the land of professional learning. Scalable was providing a platform for example, enterprise software companies to say, what if we trained our people or hired on the basis of validated skills? So put them in a virtual environment, allow them to demonstrate that they have the skills to do a job, and then hire them on a much more informed basis. So they had done a masterful job of creating technology to allow for that, but they hadn't really commercialized it at all. It was brilliant technology with limited go-to-market. And so we worked very early on with the value creation plan to say, how do we take a brilliant piece of technology, amplify this category creation opportunity, and really, stand this business up in a way that is, driving, growth, not just because it's got great tech, but because, the world knows about it and feels like it needs it. And so we worked in that case with our value creation plan with our value creation team to relaunch the brand of the business, the name, the logo, the website. We augmented the team to be more commercially oriented. So instead of having the founder decided, look, I'm a brilliant technologist and educator, but I'm going to step back and hand off, the business to someone who's kind of been there, done it before. And we ended up hiring some just phenomenal, executives. We hired a CEO, a CRO, a COO, a CMO. And a lot of that was around the commercialization of, again, some really fantastic technology. And we worked with those new executives and our value creation team to come up with go-to-market plans, including, ABM campaigns, demand gen, you name it. And between, a year after we made the investment to today, our CAGR on the ARR has been, close to 100%. And so it's been really staggering results. You do it right, and, you can drive outsized outcomes.
Is team the main lever that you look at on the value creation side, or given the nature of these companies? Obviously, team is always important regardless of the type of business, but given the nature of these companies, what are some of the main value creation levers that you're looking at outside of the people side as well?
It's unique to the business, right? And every business, and that's why we love to get the value creation team early, because there's a obvious conversation to say, are you seeing what we're seeing? Like, we're looking at it through the investment lens, and the value creation team is looking at it through on a more forensic level to say, what are the things that either can be improved upon or they're not even doing today? And so we have a value creation framework where there's something like 7 or 8 functional areas that we focus on. One is just, overall strategy. We spend a lot of time in sales and marketing, on product, on finance and business intelligence. I feel like I'm missing some systems and operations, M&A, and then the last and probably most important, you nailed it, man, is people, right? If you find the right executive to help drive the business, or there's an acute need within the business, I'll go back to that Scalable example before, it was screaming to us that you have this great piece of technology, but it hasn't been commercialized. Let's get a rock star CRO in to really drive the sales infrastructure and the go-to-market plan. And if you do that, like, you should be able to, swing for the fences from a deployment and sales perspective. So a long-winded way of saying the value creation framework is multifaceted. We get in and try to look and figure out what's going to have the most impact early on, and then prioritize the value creation plan around that.
Yeah, I guess in a lot of private equity firms that maybe have a sector focus, or they're focused on vertical software, let's say health tech, fintech, et cetera, there are these repeatable playbooks that can be brought to pretty much every business that you're deploying capital into. And there's some economies of scale or process-driven efficiencies, or even just a team like being able to kind of rinse and repeat a playbook. But inside Shamrock, it feels like there's so many different types of companies, especially when you are in this sports and digital and content and entertainment. Like you're saying, the playbook or to drive value inside these companies will look very different on a company to company basis. So how do you guys manage that internally as a firm and find some of those efficiencies so that you're not kind of stretched thin, and also actually getting the most out of the companies that you're deploying capital into?
Yeah, so it's an interesting matrix type approach. And so you're touching on something that I think is important to our success, which is While all of the partners are pretty facile across our 6 sectors, we do have majors and minors, right? And so there is functional expertise from an end market subject matter perspective at the partner level. And so we're able to leverage our experience in those particular sectors. I, for example, have spent a ton of time in the education market. So, if you think about majors and minors, education is where I spend a lot of my time. I have a network there. I've done close to 100 transactions in the education space. And so I can, bring in resource or, assess different business plans or call on former, founders, clients, CEOs to help assess a certain opportunity or business situation. So I guess one piece of it starts at the partner level. There's the investment professional that has certain subject matter expertise. Within our value creation team, we have kind of 2 approaches. Some of our value creation professionals do have, particular subsector expertise. For example, there is a member of our team that used to be a senior finance professional at Activision Blizzard. And so we obviously, whenever we're looking at something in online gaming, we want his view on, how do we see around that corner? What are parts of his network that we can tap into to assess, a particular business in that space during diligence. But we also have functional spikes. So in partnership with the value creation team, we'll look at a particular business, and I'll go back to the Scalable example, and we'll say, look, the most acute need here is they have great technology. We need that go-to-market motion. So what can we do on the go-to-market side, that combination of sales and marketing that's going to help drive an outsized outcome? And we'll work on that. The other thing, aside from the investment professionals and the value creation team, is that we often will call on our network of industry advisors. And we will, partner with an industry advisor to go attack a particular subsector where that's all they've done. Maybe they've founded several companies, maybe they've exited those companies, maybe they've been a CEO of a large publicly traded entity. Some of those people have forgotten more about a particular subsector than we'll know from a nuanced operator perspective. Being able to tap into their knowledge and know-how is really powerful. And it creates a network effect that only expands what we're already doing between the investment team, the value creation team, and their network. So it's sort of a matrixed approach, to the deal, depending on the subsegment.
It feels a bit more active than some of the other firms that we've interacted with that are more sector focused or, let's say, business model focused, because in some ways, when you can kind of rinse and repeat the playbook, there's less, I would say, I don't want to say less innovation, but it's almost, you have to be less creative because you know what works and you can kind of repeat that. In this case, it feels like not just your value creation team, but even the investment team really needs to be thinking about what are all the ways that you can drive value for this business and be more actively involved with your investments. Is that fair?
I think it's totally fair. And you know what? It gets back to where we started the conversation about, Shamrock being sector focused. Part of the beauty of only focusing on those 6 sectors is that you can think dynamically about the different themes that are affecting that sector. So we spend a lot of time thinking about, well, this particular issue is impacting an industry in a certain way. So how do we play that from an investment perspective? And then marshal resource around that. So to your point, it is an active approach, but it's always theme and sector based. And so, I think about some of the stuff that, we've been working on in the education space where I think there's a lot of hand wringing out there. You see the current administration in Washington going after the higher ed universe. And we have to sit back and think about, well, how will that A, impact the companies that we already own, and B, impact our investment strategy on a go-forward basis? And are there certain themes that we would abandon because, the Department of Education just got blown up and the administration is going after higher ed institutions? Sure. But are there opportunities to then go and invest that will capitalize on that dislocation? Absolutely. And that's where I think a lot of that subject matter expertise and that theme-based approach to investing, pays dividends. It allows us to be nimble to come up with that next new theme and then chase it from an investment perspective and augment that approach with what our value creation team does.
How are you guys sourcing these deals and differentiating yourself from other capital that's chasing similar assets in these sectors? Because definitely this is more of a unique approach that I've seen out there, but there's still other firms that are actively investing in these types of industries. So how do you really distinguish yourself for the deal flow side of the business?
Yeah. So again, I hate to keep harping this because I feel like I'm beating the drum a little bit, but that sector focus, 50 years playing in those, media, entertainment, sports, comms, that if you do it right, at least for us, we've had the good fortune of the reputation that goes along with that, we really do understand those sectors inside and out, cold. And our network is truly differentiated. And, I'd like to say we're good human beings. People want to do business with us. If you look at sort of the executives that we've had the privilege of working with, they've come back to work with us again. And same with sort of, other firms that we've partnered with. So from a sourcing perspective, that theme work drives a lot of sourcing. But more importantly, our connectivity to those themes is differentiated because of the network that we have by growing up in those sectors over 50 years. And so, I said earlier that part of the benefit of having that sector focus is we get a lot of proprietary looks. Those proprietary looks are because we've known, a particular founder or an executive or a consultant or banker or industry exec for, in some cases, decades. And when they get that phone call to say, hey, I'm finally thinking about doing something with my business, is there anybody that I should talk to? If it's in one of our sectors, 9 times out of 10, we're getting that call and we can have an adult conversation with them about why we might be the right partner. And maybe running a process isn't the right thing to do. Maybe we can help achieve whatever goals, they have without having to go out to sort of the broader market. And I look back over our last several funds, particularly since, I've been here, and a majority of our deals are proprietary or, what I would call semi-proprietary, where they're only talking to, a small handful of people. You can count them on one hand and not all the fingers. Now, that doesn't mean to say that we're not playing in banked processes, but even in those, that connectivity to the sector pays big dividends because that's the way that we differentiate ourselves. We show up, we speak the same language, we talk about, proactively, what can we do for your business? Well, let me tell you what that network can deliver to you, what doors that we can open that will add value and help amplify growth or profitability depending on what the goals are of that particular founder, management team, or shareholder base.
Are you pitching the part about your investment team being actively involved more operationally than most? Because I look at your value creation team and there's about 8 people there, but you have a large investment team that has the sector expertise and the background and all of that I would imagine is getting involved with these companies as well. Is that a big part of the pitch to these companies as well?
Yeah, I think it's a balancing act. I do. And I say that because to oversimplify, there's sort of 3 types of investors, I feel like, out in the PE world today. There's the guy, the dog in the truck with the checkbook who's like, hey, here's the check. I'll see you at the quarterly board meeting. Don't screw it up, right? There's the opposite end of the spectrum where you've got somebody who has got a small army of people that are, represent their value creation team. And the deal closes, you got, 40 people in 3-piece suits and 3-ring binders camped out in your kitchen telling you how to run your business. And then there's this happy place in between. And I think we're one of those firms that lives in between, where we're leveraging our theme-based approach to investing and our sector knowledge for pattern recognition. I'm not going into a business and telling you, hey, you're not doing a good job or you need to run your business differently. We're leveraging close to 50 years of pattern recognition to say, hey, based on the investments that we've made in the past, based on our network knowledge and know-how, pattern recognition would suggest that you can do these things to help amplify the growth of your business. And it's a partnership at the end of the day. We take more of a partnership approach of saying, how does that pattern recognition going to impact or help you go or grow faster? I'm not going to show up and, try to reinvent the business. So long-winded way of saying, I think our approach is about partnership and balance, not about walking in and telling people that, hey, we're going to, put the surgical gloves on and get in the weeds with you. If we need to, we will. And the value creation team does, go forensic, but more on a partnership driven basis where we've identified a particular issue that we want to, get our hands dirty on, and we'll go work on it together.
Right. So it's more coming in cases where that is a unique value that you can bring, but in general, letting the company still operate because they're running a good business.
Yeah, for sure. And look, we're more growth investors. And so I think there are value creation teams out there. And I'm sure, I know that you've talked to some of these folks before, that's how they add their value is, they get in there and they kind of decode and rebuild a business to drive value. I think our value creation efforts, because we're growth investors, are often more about how do you go and grow faster. And I think that's a little bit of a different exercise. There is nuance to those two different, business models.
Yeah. Yeah. What about in terms of sourcing LPs and that side of the business? Because you're investing in these types of different companies and different sector focus, are you sourcing capital from different types of LPs or people that really understand this space? Because I would imagine that there's some differences between Shamrock and other firms that are investing in more traditional companies.
Yeah, I think that in recent years, at least our fundraising would suggest that in a sea of private equity firms, subject matter expertise matters. People are looking for, when I say people, I mean LPs are looking for, firms that have some sort of differentiated approach. For us, that sector focus and theme-based approach to investing has served us well. And it's funny, when I was a banker, I used to do a lot of calls with LPs that were diligencing funds to say, hey, what makes them, different or special? And I'd say that now sitting on the buy side and talking to our LPs, there is an affinity and a belief that subject matter expertise matters. You show up differently in processes, you have more proprietary conversations, and those LPs aren't just investing in a pool of capital that's going after, either a general industries approach or, a massive subsector. They want to understand that there's true differentiation. And so, from a investor perspective, not all of our LPs, I'd say, are, experts in the space, but that's why they're interested in us. They want to come, work with or back subject matter experts and that are taking that theme-based approach to investing and feel like that will drive differentiated results.
In terms of the types of investments that you're making and the types of LPs that you're working with, how are you setting expectations for returns? Like when you think about just fund strategy overall, some of these assets that you're investing into, I would imagine the horizon looks different. How you're going to grow these companies looks different. So how do you manage those types of expectations and also finding liquidity for LPs, especially in the current macroeconomic environment?
Yeah, I mean, candidly, even though we are taking a different approach, I don't think that the goal is any different in terms of IRR, DPI, expectations of a great top quartile private equity firm. We're marching to that same beat, and I think that our historical performance, would suggest that our approach has driven those sorts of outsized outcomes and returns. But when it comes to sort of that more macro question of like, are we coming at the world differently in terms of like, are we more, patient capital, or are we underwriting to sort of a non-traditional PE model? The answer is, no. Our LPs expect the same, great outcomes of, any top performing private equity firm. And I think we've done a good job of, delivering on that. I will say that as it relates to, situations that are maybe, more unique or take more time, that given our heritage, we grew out of a family office, this notion of exercising patience to deliver an outcome is something that, for the right opportunity, we certainly will pursue that strategy. And I think that our LPs appreciate and understand that, being sector focused and given our heritage, there may be situations that could lead to a better outcome if we're more creative or we take a different approach. And there are investments both in previous funds and in current funds that are good examples of something that may be slightly less traditional than what you'd see at other private equity firms, but our subject matter expertise and theme-based approach allowed us to go there.
How has technology and the AI side and all these advancements that are coming, how has that adjusted your investment strategy or how you're thinking about value creation, and specifically in the sectors that you're looking at, even though you're in like games and film and like a lot of these industries that I would say have an offline component in some ways? Like, how do you look at that in a world where now AI is becoming a more and more prominent part of it?
Well, it is an inescapable issue that we face, and we're coming at it from sort of multiple directions. We, for several years now, have worked with an AI consultancy, both to think about revenue opportunities across the portfolio, as well as cost saving initiatives, right? So, AI can help on kind of both sides of the ledger, but the way that they're impacting companies depends on the business and, the go-to-market. And so that AI consultancy helps think about that on a company by company basis. Inside of the fund and the value creation team, we've recently named a head of innovation that is helping drive a more proactive approach to leveraging AI tools for everything from sourcing to research to analysis to even decisioning. Not decisioning like on deals, but where we kind of spend our time and bring in additional third-party resources to dig deeper. And I think that that's just the beginning of a much deeper dive that not just Shamrock, but really every and any private equity firm will, if they're smart, will have to be undertaking. I think AI, if we use these tools appropriately, they're going to allow us to, do our homework faster, arrive to decisions with greater conviction, and within the portfolio, ultimately drive value, like I said, from both a revenue and cost perspective. I mean, it wasn't that long ago that I think most private equity firms, weren't necessarily assessing both the opportunities and risks associated with AI. I know at Shamrock, in every single investment committee, that is 100% part of the conversation now. And also when we do our quarterly portfolio reviews, talking about how our portfolio companies are either using AI or what the potential threat of AI is, that, and how do we play both offense and defense. I think that's table stakes now, man. I really do.
Yeah, I was going to ask about that. Like, how do you look at risk and the threat of AI? Because in the media, content, sports, just entertainment space in general, there are a bunch of risks associated with content or AI generated content and things like that. And there's a lot more that if we can kind of dive into. Just curious, like, how do you perceive that as you're underwriting investments or thinking about value creation plans, or what a reasonable expectation would be in terms of growth trajectory for these companies?
Well, I'll tell you what we're trying not to do. All right, we're trying not to see ghosts at every turn, right? Because I think that AI, for better or for worse, has become a little bit of this boogeyman that people are freaked out about. And instead, what we're trying to do is take a more rational and thoughtful approach to, working with both our external and internal resources that are responsible for understanding how to leverage AI, how to play both offense and defense, and use it. I mean, quite frankly, there's an education process. Right now, for example, we're working on a recapitalization of one of our businesses. And a lot of the questions that we're getting from prospective investors are about the threat of AI to this business. And what we've had to do is spend a lot of time putting our arm around those prospective investors and being like, we're actually super fired up for AI. Here are the reasons why. Here are the AI tools that we're using inside of our business that are helping, create efficiencies, but also drive revenue growth. Here is the AI opportunity this particular business plays, in and around the education market. And so one of the topics that this business helps train on is AI, and that's a huge growth driver. Once you start to educate people that, hey, this is not that ghost or that boogeyman, but it's an opportunity, and we're addressing the risks associated with it by not sitting still and waiting for things to happen, but proactively incorporating AI tools or thinking about how to address the issue proactively. That temperature kind of goes down and some of that fear subsides. But I don't want to downplay it either. We're looking at, in every potential new investment and every existing investment, we are assessing that risk both internally and through our third parties.
Yeah, I think the big opportunity is to expand margins more so than the threat of it kind of displacing a core business. I think that may be further out in a lot of cases. So finding some of those margin expansion opportunities can be huge by leveraging AI. So I think that's great. As we come up on a close here, Mike, as you think about your companies and what investors are kind of thinking about, any advice for private equity firms that are listening, especially in terms of how you approach things at Shamrock and what's really worked well for you?
Yeah, I'd say two things. One is where we just left off, which is AI. And I think private equity firms are getting smarter about, leveraging AI and pushing kind of the AI conversation down to the companies. But one of the things in talking to some of my peers that seems to be an impediment to, just moving forward is that it doesn't have to be this you don't have to solve everything at one time, right? I think the hardest part is taking that first step and embracing the idea that, yeah, look, I know we have to address AI, so let's start somewhere. We're running workshops, for example, with CXOs across our companies, talking about what is that first step that you can take inside of your company? What are some of the tools on the AI front that should help address thinking, if nothing else, just thinking about how you can use it for both revenue optimization, but also for cost efficiencies. And so, I guess one piece of advice for, some of those peers that aren't, taking those steps is it doesn't have to be this monumental kind of, epic thing. It can be more bite-sized. You just got to take that first step. I'd say the second piece is, and again, far be it from me, I'm not knocking anybody's success because there's been no shortage of firms that are generalists out there that have crushed it. But I do think that vertical specialization, expertise, and that theme-driven approach matters. And particularly in a world where capital is a commodity, taking an approach where you are deep on, themes and sectors is a good way to differentiate. Not everybody can do the same things. And so, figuring out what that means to, your firm, I think it is a key differentiator, and it's only getting louder as time goes on, and there's just a ton of capital out there.
Those are two great takeaways, Mike. So thanks for sharing those. And I completely agree. Specialization is the way to kind of break through the noise and get deal flow and generate more returns and all of that. So appreciate you sharing those. And last but not least, before we close off, if somebody wants to get a hold of you, what's the best way to reach you or Shamrock?
Yeah, sure. I mean, you can go to our website, which is shamrockcap.com. You feel free to also send an email. It's just mwilkins@shamrockcap.com. And we're typically super responsive.
Awesome. Yeah. And Mike, before we close, I just want to say thanks for coming on and sharing your wisdom. I think that's a very interesting approach, and the types of companies you're investing in is different than a lot of the private equity investors that we've had on the podcast. So appreciate you coming on and sharing your approach and perspective and how you look at value creation. I think it'd be super insightful for a lot of people that listen to the podcast. So appreciate you doing this.
Yeah. Thanks for having me, Shiv. Really fun, and appreciate the opportunity.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.